Greetings class, Dr. Royer here. This is chapter 6 of Valuing Stocks and Bonds, and in this chapter we're going to talk about valuing bonds, what bonds are, identifying present value of bonds, and so on. So a bond is an issue from a corporation or government entity of debt, basically borrowing from the general public, and in that debt there is a certificate or bond issue that where they give you a certificate, and on the certificate you'll see a face value amount, you'll see an interest rate stated, and a length of time when it matures. Most of these bonds have a face value of $1,000. That's typical, that's the standard practice, and that is the par value of the bond. It's stated right on the front of it. There's also a coupon rate, a rate of interest that's stated on the bond, and that is the rate that's paid in interest on these bonds every year. Many of these bonds are set up on semi-annual payments, so you'll have a payment of interest on the bond every 6 months. The bonds will continue to pay interest until they mature, which at that time the company or issuing body will then pay the bondholder of record for the face value of the bond as well as the interest. The value of a bond can be understood to be the present value of that future value of the present value of the future payment of the face on the bond at the time in which the bond matures, in addition to a series of payments of interest from the bond issuer. So when we look at that, we value the bond based on these cash flows like this. An 8% bond for 10 years, going to pay $80 a year, and at the end of 10 years, $1,000 payment for the face will then basically pay off the bond. And then cash flows will have an annuity component and that lump sum component at the end of the period. So we compute the value of the lump sum amount, $1,000, and then we compute the present value of the annuity piece, the payments on the interest. Add those together, and because this bond is issued exactly at the market rate, it's going to be $1,000, which is the face value. That doesn't happen very often. Many times the interest rate will be different on the bond than it is in the market, and if it is, the bonds will either sell at a discount if their interest rate is lower than the market, or at a premium if their interest rate is above the market rate. And keep in mind, when we're computing the present value of these payments and these cash flows, we're using whatever the market interest rate is when we're computing the amounts with these interest payments here. Now that will automatically adjust the price of the bond. So if we calculate the bond, in this example the market rate went up to 10%, but the bond was issued at 8%. So the face value is not worth what it was before. The par value, when at redemption, you're going to get $1,000. But what's that worth now? At the rate that's lower than the market, it's going to be $424.10. And then the coupon rate is lower than the market as well, and so those are going to be $460.72, and the total of those are going to be approximately $885. And that means the bond is selling at a discount because the yield on the bond is lower than the yield in the market. If the yield on the bond is higher than the yield in the market, it will sell at a premium. And if it does, then you'll do the computation like this. In this case, the bond was issued at 8%, but the market is only at 6%. Therefore, it changes the present value of that payment in the future to $591.89, and then the payment of the interest payments every year for the next 10 years goes up to $544.14 because the market rate is 6%, but the bond is paying 8%. We add those together and we get a total price on the bond itself of $1,136.03, and that is going to be a premium or above the value of the bond that's on the face. These discounts and premiums are used to adjust what we call the yield on the bond, that is the combination of cash flows compared to the investment we make. And when we adjust the yield, we're adjusting the yield back to whatever the market yield is. So in those two cases, in the case of the discount, we were saying the market yield should be 10%, but the bond yield is only 8%. Therefore, we're going to pay less than the price on the face of the bond in order to earn more money. If the discount rate or if the market rate is lower than the bond rate, then we'll be paying a premium because we're going to adjust that bond yield over the course of the time that we have it. We'll adjust the yield back to whatever the market is. So we'll be willing to pay more for that. There is inherent interest risk in bonds, and the reason is that bonds are typically issued for a long period of time. The longer you have the bond, the greater the risk that the interest rate will no longer match up with what's in the market, and that you could be locked into an interest rate that is lower than the market and have a risk of financial loss in that way. Many bonds are issued at 30 years time. They do mention a few here that are issued for 100 years. That may be the case. There may be some companies now trying to do that because the interest rates are so low. And if there are low interest rates, then that's going to make the issuance of very long-term bonds very attractive for businesses. So, how do we find the yield to maturity? Well, if the interest rates are different from the market, we're going to have to factor in whatever the discount is or whatever the premium is to understand what the bond yield is to maturity. And they show the computation here of the price of the bond. But the bond value and the bond value here. And what they're showing you is that when you compute these present values at an interest rate that's 8%, or 10%, the 10% rate's too high because we wind up with a premium. The 8% is too low. Well, it must yield between 8 and 10%. The face value is 8%, market rate 10%. And we're still getting lower than the face value here. So it's really a matter of trial and error where you're actually computing out to see where the bond ends out very closely to the par value. So you're here you have 10% and you have 912.89. So you may need to move may need to move down to 9% to see what you would compute. So actually getting to a point where if we're purchasing a bond and the bond purchase price is exactly the par value, that's a very rare event. But here, with the numbers we have, we can see that the current yield is $80. That's the payment every year divided by the purchase price of the bond. That's 8.38%, which is less than the yield to maturity of 9%. And here's they discuss that the current yield rate's too low because it only considers the coupon portion of the return, doesn't consider the built-in gain from the price discount. So there is a difference there. Now, you look at this summary of bond evaluation here, you can see what these different symbols mean, how to compute it, and exactly what those mean, how to find the yield on a bond. Here are some calculator hints. Certainly look at these when using your financial calculator with these kind of problems. A spreadsheet strategy here with these Excel, again, like I said in the past, you can put all the details into the spreadsheet and compute out the yield. You can compute out all the different components, and again, there is a specific yield formula for this in Excel, as well as a price, bond price, and this is now, look, this is percent of par, so it's going to be less than par. More on bond features. When we're talking about bond features, debt on a business is not ownership, but it is a liability. So when you have debt, when you have liability, when you have bonds, you have some liability on the part of the corporation, and these are typically called notes, debentures, or bonds. Most of the time, a bond is a secured debt. It can also refer to all kinds of secured and unsecured debt, but in our use here, it's a very generic form of talking about a debt form for a corporation or business in order to raise funds. There are differences between public and private issued debt. Typically, if you're buying bonds in a public issued debt, it's tax-free. The interest is tax-free. You may be purchasing private bonds, and if you are, those are going to be taxable. But here they give you some examples, features of an Excel mobile bond. They talk about the offer price, and when they talk about bond offer prices, they express them as percentages. So here, 99.55 means it's 99.55% of the face value. Coupon payment dates, when are they going to pay those interest payments? Here it's 4 times a year. It looks like. And then you have, 2 times a year. And there's no security on them, and there's not a sinking fund on them. There's a call provision in them. When they say call provision, that means the issuing company can call them back at any time. The call price is whatever it is they're going to call these. They're going to pay you the treasury rate plus 10%. And then the rating for the bonds, Moody's is AAA, S&P AAA. So you can see what kind of credit rating the company issuing these has. To begin with, a bond is governed by the indenture. A bond indenture is a document that's a legal document, and it's prepared between the corporation, who's the borrower, and its creditors. It's also referred to as a deed of trust. Usually the indentures are a rather lengthy document, rather detailed document that covers quite a bit of the details that are involved in the bond issue. So you have basic questions answered, like the terms of the bonds, the total amount of the bonds that are being issued, the property used as security, whatever the repayment arrangements are, usually call provisions or details of any productive covenants. There may be other things included, like things like what the bonds are being issued for. And while it's a very big and dense document, like they say here, it is very tedious reading, and I know I've read a few of these. I've examined a few bond issues in the past, so I can tell you it is very tedious reading. Now, most of the corporate bonds that are issued with that $1,000 historic denomination, although there are par values that have become common, like 2,000 at ExxonMobil. These are the principal values. Usually corporate bonds are registered, and what I meant earlier by that was that there's an agent that keeps track of who bond owners are, So if they're purchased and sold in the secondary markets, they keep track of who actually owns the bond on a specific date when the interest payments are paid. Whoever owns the bonds on those dates gets that interest payment. The negotiation of the price between the seller and the buyer of the bond usually involves some negotiation for the proration of that interest payment between the two, if the purchase or sale of the bond is outside of those normal times when they pay interest. There are occasions where bonds can be issued in bearer form. That means there's not a registered ownership. Whoever has the bond document can actually claim those bonds. They can actually take them and sell them. A registered bond is different because the ownership is recorded, but a bearer form bond is not. There's some danger and risk in that, anybody who finds those bonds can actually cash them in. The drawbacks to bearer bonds are they're hard to recover if they're lost or stolen, because the company is not going to keep track of who owns them, and it can't notify bondholders of any important events. So bearer bonds were once the normal type, but they're now far less common because of the risks rather than the registered bonds. Debt securities may be classified based on their collateral, how much collateral is involved or what collateral is involved in it. For example, collateral trust bonds involve a pledge of common stock held by the corporation, but collateral can be used to refer to any asset pledged on a debt. You can have mortgage securities. Those can be basically secured by the mortgage on property of the issuing corporation. A debenture bond is unusual. Well, it's not unusual. They do issue these, but it's an unsecured bond for which there's no specific pledge of property. So a debenture bond is like other bonds. It's long-term. Typically, other factors that we talked about here are similar. The only difference is there's no security on those. A note is different than a bond because a note is generally used for instruments if the maturity is less than 10 years when the bond is originally issued, or so when the bond is originally issued. Debenture holders have a claim on property not otherwise pledged. What that means is after the mortgages are paid and collateral trusts are taken into account, whatever's left is available to settle the debt on the debenture bonds. In general terms, when they're talking about seniority, they're talking about the preferences and position over other lenders. Debts are sometimes considered senior or junior depending on what kind of debt is involved. Some debt is subordinated, which they would be talking about a subordinated debenture, which means that other debt would come ahead of that debt in a liquidation process. But when we're talking about the seniority of bonds, typically the ones that are most secure are types like the mortgage bonds or collateralized bonds. Debentures are the least senior. And when they repay the bonds at maturity, that's what they're supposed to do. But many bond issues require the business or corporation to establish a sinking fund where a bond trustee actually puts a certain amount of money in each year in order to ensure that the company has enough money in the account to pay the bond issue when it's time to pay the maturity of those out. So if they issued a rather large bond issue, typically there's somebody, a bond trustee, that's going to basically be putting in money into this account to make sure that there's enough there to cover the principal on these bonds when they mature, when they're due to be redeemed. So some sinking funds may start later in the process, 10 years after. Some establish equal payments into the fund over the life of the bond. And some high-quality bond issues establish payments into the sinking fund that are not sufficient to redeem the entire issue. And as a consequence, there's a possibility of a large balloon payment at maturity. So in some cases, they may not really have a full sinking fund that can pay the debt off once it comes due. A call provision allows the corporation, the issuer, to call the bonds in at any given time. Typically, there's a call premium attached, so if the bond issuer wants to pay the debt off, they can, but there's usually a premium that they have to pay to the owners of the bonds. And basically what they say here, one arrangement is to set the call premium equal to the annual coupon payment and then make it decline to zero as the call date moves closer to the time of maturity. Call provisions are not usually used during the early part of the bond's life. It doesn't make as much sense then, but once you get into the later years of a bond, it may be that it's more advantageous for the corporation to pay those bonds off and issue new ones, particularly in an era of declining interest rates. The company may be prohibited from calling its bonds for the first 10 years. In that case, it's a deferred call provision. And that might be of interest to some bond owners because they might not want to have the bond called immediately. There are sometimes protective covenants that limit some actions a company might take during the term of the loan. So a protective covenant can be either negative or positive. A negative covenant really is it limits or prohibits actions that the company might take, such as they must limit the amount of dividends it pays according to a formula, can't pledge any assets to other lenders, cannot merge with another firm, cannot sell or lease any major assets without approval by the lender, or it cannot issue additional long-term debt. Positive type of covenant basically is instructions to the company issuing the debt saying that they must maintain certain conditions. So in this case, they must maintain working capital at above some minimum level, and they must periodically furnish audited financial statements to the lender. This is very typical, mainly because the lender wants to make sure that the company is still solvent and that they are what in accounting is considered a going concern. They must maintain any collateral or security in good condition. They must take care of it. And then we get into bond ratings. Firms often pay for this service. They want the bonds rated mainly because the bond ratings are a reflection of the creditworthiness of the company issuing the bonds. And they give you examples of what those ratings look like here. And typically the highest level, Standard & Poor's is AAA, Moody's AAA, and you may have a high grade, medium grade, low grade, very low grade. In the past, there have been varying values or varying ratings on bonds. There have been some people who have gotten into the market and speculated in what they call junk bonds, which are really bonds that don't have a lot of value, not a good credit rating, and so on. Sometimes those things are, speculation is what they are. It's not truly like an investment, it's speculation. So, and it doesn't serve the same purpose of what we're talking about. We're talking about it from the perspective of the issuer, to know what these ratings mean. It is very valuable to have a high rating, a AAA rating, and basically the capacity to pay interest and principal, not premium, principal is very strong. In the 80s, corporate borrowing had gotten involved with low-grade junk bonds. That's what I mentioned earlier. They may not have been rated at all. Most of them weren't, but if they were rated below investment grade, and there was certainly a great deal of risk involved with those. Okay, so different kinds of bonds. Well, there's a government bond. We've already mentioned that. You can buy a bond issued by the federal government. Treasury bills are an example of that. And usually those are the most secure kind of investment because typically the Treasury has the ability to tax and does not run the same risk that a company does of going into bankruptcy. State and local governments may also issue bonds. Those are municipal bonds and are tax-free under the U.S. federal tax code. But usually these are going to be attractive to high-income, high-tax bracket investors simply because they can get a return on their investment but also not pay any tax on that. So when we're talking about comparing taxable versus municipal bonds, there's an example of it here, and that you can look at and really kind of consider. There's a comparison of what the value is in a tax-free bond versus a regular investment. Zero coupon bonds, they don't have any coupons, but they are offered at a price that's much lower than the stated value. That way the yield is actually the return. You don't have any kind of a coupon on that, but your return will be the difference in the purchase price and the redemption price. Here it says, suppose 8-inch Nails has issued a $1,000 face value 5-year zero coupon bond. The initial price is set at $508.35, even though no interest payments are made on the bond. Zero coupon bond calculations use semi-annual periods to be consistent with coupon bond calculations. Using semi-annual periods, it's straightforward to verify. At this price, the bond yields 14% to maturity. So quite a yield, actually, when you start thinking about that. Here's when you're talking about the zero coupon bonds and the interest expense. Basically, it's an implied interest expense. You're not actually seeing the interest expense, but it's sort of a straight line calculation of what that is. Over here, here it's implied based on the beginning value and ending value. Now, what this is an amortization schedule that actually takes the beginning value of the bonds and over a period of 5 years brings them up to their face value. This beginning value is actually the cost that you're going to pay for them. Floating rate bonds are bonds where you have a rate that can change with the market, and they're typically tied to an interest rate index, like the T-bill interest rate or 30-year Treasury bond rate. So those, basically when they say floating rate, that means the rate that's paid on the bond itself can change over time. There are many different kinds of bonds. You have some bonds that are structured notes. Basically, they're bonds that are based on stocks, bonds, commodities, or currencies. A convertible bond, this one is probably a little more common. It can be actually, a convertible bond is a bond that can actually be exchanged for a number of shares of stock in the company anytime before the maturity date on the bond. So you can basically trade that in and get stock instead of a bond. A put bond allows the holder to force the issuer to buy the bond back at a stated price. The put feature is the reverse of the call provision, and it's relatively new. So basically that's kind of what that is. With these bond markets that we're talking about, they're going to be bought and sold in New York Stock Exchange and other markets around the world. There's a lot of people out there issuing bonds, and there are places where you can go to find out what those bond prices are and what they're trading at, just like with any stock. So you can track those issues and what their values are. Treasury quotes are basically what represent over-the-counter quotations for some of these. You can see here what they're showing: a bid price, an ask price, and an ask yield. So you see the differences there. So with bonds, there's always a bid price and an ask price and a spread between the two. That's the difference between those. Inflation and interest rates do impact bonds more than perhaps stocks, mainly because fluctuation in interest rates impacts the value of the bond itself. So they talk about some things here, including a difference between real and nominal returns, a relationship they describe as a Fisher effect. Because investors are ultimately concerned with what they can buy with their money, they require compensation for inflation. So we're talking about when inflation hits, investors want that to be factored in. What determines a bond yield? Well, most of the time we're talking about interest rates and the time that the bond is going to be in the market. There may be a lack of certain features in a bond. There may be some other features that are available in a bond and make it more attractive. Again, here when you're looking at this structure, you have interest rate risk premium. In other words, if it's a longer term, you're going to have increasing interest rate risk. There may be some inflation premium that's involved, but it's all going to be considered in this actual price of the bond. This is in an upward sloping structure. It is if interest rates are going up. If they're going down, it's going to look more like this. When you talk about bonds in the yield curve, basically you're looking at here's the Treasury yield curve, and you're looking at the term structure of interest rates and how they impact the yield or the return on these bonds. So the term structure is based on pure discount bonds. Yield curve is based on coupon bond yields. So you have a slightly different perspective there. Okay, I think that pretty much covers Chapter 6. So let's look at the questions we have in the assignment for Chapter 6. And in 6, you're going to write a short answer to 6.1, 6.2, and 6.6. So 6.1 is it true that a U.S. Treasury security is risk-free? No security is ever totally risk-free, but in terms of the market, Treasury bonds are considered to be risk-free. But you'll need to explain why that is when you look at this and talk about this. 6.2, which has greater interest rate risk, a 30-year Treasury bond or a 30-year BB corporate bond? Which one has greater risk? And you can argue your point and talk about that. In 6.6, how does a bond issuer decide on the appropriate coupon rate to settle on its bonds? Explain the difference between coupon rate and the required return on a bond. And then in the questions and problems, we have number 1, which is the yield to maturity on a bond the same thing as the required return? Is yield to maturity the same thing as a coupon rate? Suppose today a 10% coupon bond sells at par. 2 years from now, the required return on the same bond is 8%. What is the coupon rate on the bond now? The yield to maturity. Okay, that's number 1. Number 3, Lycan has 7% coupon bonds on the market that have 9 years left of maturity. The bonds are making annual payments and have a par value of $1,000. If yield to maturity on the bonds is 8.4%, what is the current bond price? And basically you're going to figure out, because you're talking about a difference between a yield to maturity of 8%, you want a yield to maturity of 8.4%, but you're only going to have, based on the face value, 7%. So how do you get to that? And then number 5, Coupon rates. Barnes Enterprises has bonds on the market making annual payments with 12 years to maturity. Par value of $1,000 and a price of $9.63. At this price, the bonds will yield 6.14%. What must the coupon rate be on the bonds? And this is going to require you to calculate the coupon rate. And then number 23 in these questions is you purchase a bond with an invoice price of $1,043. The bond has a corporate rate of 5.7%, or coupon rate of 5.7%. Semi-annual coupons, a $1,000 par value, and there are 5 months to the next coupon date. What is the clean price of the bond? Well, what you're going to do is you're going to calculate to include how much interest is being purchased by the new purchaser. How much interest are you purchasing on that bond at the time when you purchase it? The owner of the bond is only getting interest up to the time of the sale, so you have to split that interest payment with the previous owner. Okay, so those are the questions, those are the problems, and that's Chapter 6. If you have any questions about any of that, I look forward to seeing your work.